Hello and welcome to the Retirement and Money Show. So in this video, we're going to look at what happens when the stock market drops. Well, the reality is when the stock market does drop, in my experience, people start to panic about their pension. But what if I told you that's actually the wrong way to look at it? Because actually a falling market could be one of the best things that can happen for your pension. So in this video, I'm going to explain why market drops feel scary. Then I'll show you the supermarket trick, as I like to call it, that changes everything. And I'll walk you through some real examples of how this works. And at the end, we'll finish with the practical next steps and a quick summary. So by the end, you'll understand exactly why market falls can actually help your pension. You'll know what to do when you see your pension value drop. Plus, I'll share with you the one mistake that I see that costs people thousands of pounds. So my name's Sack Hussain, and I've got over 25 years experience of helping people plan for their retirement. Okay, so let's start with why market drops or falls in investment markets can feel so terrifying. You know what it's like. You log into your pension account online and you see that the value has fallen. So naturally, your first instinct is to do something about it straight away. Maybe you stop your contributions until it's settled down, or you switch everything into cash where it feels safer. Now, this reaction is completely natural and totally understandable. But this is the thing you need to be conscious of. And that is, what you're seeing is just a number on the screen. You actually haven't lost any money at all. That's because your pension still owns the same number of units. All it is that the price of those units has just dropped for now. And this is where the supermarket comparison gets really helpful, I think, because when prices drop at the shops, we react completely differently. Because when your food goes on sale or stuff that you like to buy, you buy more of it. You don't panic and stop shopping altogether, do you? But when pension prices drop, most people do the exact opposite, which I find really, really strange. But what they end up doing is they stop buying at the worst possible time. So coming up, I'll show you why I think this matters so much. Now here's where things get really interesting for your pension. Every month, your contributions buy units in your pension fund. So when prices are high, your money buys fewer units. But when prices are low, your money buys more units. It's only natural. So a market drop is basically a sale on pension units. And this is called pound cost averaging, and it's a really, really powerful tool. So let me start by giving you an example of how this works. So just imagine you're putting £200 every month into your pension. When each unit costs £2, you get 100 units. But when the price drops to £1, you're going to get 200 units instead. So that's double the units for exactly the same money. Now, when the market recovers, those units grow with it. They haven't gone anywhere. So you end up with more money than if the prices never fell. But this only works if you keep contributing through the drop. And unfortunately, in my experience, this is the bit that most people get wrong. What they tend to do is fear takes over. They think it's a bad investment, so they stop contributing when those prices fall. So effectively, they've missed out on the sale completely. It's a bit like refusing to go shopping during the January sale. So next, I'm going to show you some real examples of this in action. Right, so let's look at what actually happened in real life. And those of you that are old enough to remember, think back to the 2008 financial crisis for a moment. And back then, the FTSE 100 dropped over 30% in that year alone. Now, people who panicked and stopped their contributions, well, they've actually missed out really, really badly. But those who kept paying in bought units at rock bottom prices. So when markets recovered, what they found was that their pensions had grown much faster. And the same thing actually happened a few years ago during the 2020 COVID pandemic, when the markets crashed back in March of 2020. So they fell quite sharply, but by the end of the year, they'd actually recovered. So anyone that was contributing through that period actually picked up really cheap investment units. Now, here's a key point you need to understand about all this. Historically, markets have, in most major downturns, recovered over time. The 2008 crisis took about 3 years for the market to recover. The 2020 crash recovered in less than 12 months. So if you have more than 5 years until retirement, in my experience, I would say don't worry, because historically markets have always caught back up in that time. So for me, these drops are actually opportunities in disguise. Your monthly contributions are buying at sale prices. But the only people who should worry are those that have already retired, actually. So in the next section, I'll tell you what exactly you need to do. So you've seen the markets have fallen. Well, what do you actually have to do? Well, first and most importantly, keep your contributions going. Don't worry, don't reduce them, and definitely don't stop them altogether. And that's because every payment is buying units at cheaper prices. Now, I know I've said this a couple of times now, but it really is important to reiterate. Second, and I really highly recommend this, is not to check your pension balance too often. Looking at it daily will just make you anxious for nothing, and it might make you make bad decisions. So, you've got to remember your pension is a 10, 20, or even 30, possibly even 40-year investment. So short-term drops don't matter over that kind of time frame. And third, if you can afford it, actually consider putting in more money. You'll be buying even more units while prices are low. And don't forget, you get a tax relief on everything that you contribute up to a certain limit. Fourth, check how far you are from retirement. So if it's more than 5 years, you can ride out any ups and downs. But if it's less than 5 years, I recommend you do see a financial advisor. And finally, remember, this only applies if you're still contributing. If you're already retired and taking income, it's a different situation altogether. And that's because market falls whilst you are withdrawing money can hurt you permanently. And this is called sequencing risk and needs careful management. And we've got some other videos on this that can help you understand that more carefully. So hopefully everything I've talked about has made sense and helps you understand why actually a falling stock market can be a good thing for you, especially if you've got a number of years to retirement. As we get to the end, let me just quickly summarize the key points from the video. And again, to reiterate, a falling market feels really scary, but it is not always bad news. Don't follow the doom and gloom that you sometimes see written in the press or online. It isn't as bad as you think. And if you're still contributing to your pension, it's actually good news. And again, that's because your monthly payments are buying more units when the prices are down. So in the industry, this is called pound cost averaging, and hopefully you can see it's actually a really powerful approach. And when markets recover, those extra units are going to grow in value too. Now, the worst thing you can do is to stop contributing. You'll be missing the sale and buying only when prices are high. And that isn't going to help your pension pot over the long term. And don't forget, history shows us markets in many cases recover from crashes. And they do so normally within those 5-year periods. So keep your contributions going in no matter what the markets are doing. And don't check your pension too often during difficult periods. And if you can afford to do so, highly recommend this. Consider putting more in if you can afford to. And if you're in an employer's pension scheme, have a look to see whether you're maximizing the amount of contribution that they are willing to make on your behalf. Because again, this is potentially free money that you are just turning away. And the people who do best are those that stay calm, to keep their head down, to keep investing through the good times and the bad. And the supermarket sale analogy I used on your pension won't last forever. So make sure you're buying while prices are still low. So I hope you found this video useful. If you did, please do give it a like and do subscribe to our channel where we have lots of content related to pension and retirement planning. Finally, good luck and goodbye.